Good morning, good afternoon to everybody. Thank you for signing in for our second Meet the Expert webinar. My name is Rob Whittall. I think you most all know who I am, and it gives me great pleasure to introduce Jamie Debenham today from Brooker Insurance Agency. Jamie and I have known each other for a long time, and Jamie actually grew up in the Cotswolds and came to the US in about 1984 and stayed ever since. And for the last 25 years, he has been working in the healthcare insurance industry. And I think we thought this would be a great presentation for everybody, because there's such a difference between how healthcare is accounted for in the UK and how healthcare is accounted for in the US. So without further ado, I will turn it over to Jamie. And once again, if you'd like, as we're going through, please type in your questions. We're going to present for about 40 minutes and then try and answer as many questions as possible at the end. And the ones that we don't get to, then we will follow up individually afterwards. So thanks very much, Jamie. And if you'd like to start, that would be great.
Thank you very much, Rob. It's a great privilege to be able to talk to everybody regarding this subject. I know it's a tough subject for everybody to get their heads around because especially in this time, it changes almost on a daily basis. So I will attempt to go through this and bring some levity to it. Okay, so essentially we're just going to go over the healthcare reform. We're going to talk about how it applies to large employers and then small employers, very briefly on how it applies to individuals. We'll then also talk about alternatives to PPACA, which is the Healthcare Reform Act, and then we'll also show you some slides on what employers are doing as far as offering benefits to their employees and how it's financed and what the employees are doing as far as their contributions, etc. Okay. So the Patient Protection and Affordable Care Act was passed on March 23rd, 2010, or it was signed into law by President Obama at that time. It has multiple facets to it. Hospitals have to comply with it, businesses have to comply with it, insurance companies, etc. This presentation is going to focus on the insurance side of the reform. So for large employers, the definition of a large employer is a company that has 50 full-time equivalent employees. Now, what is a full-time equivalent? That is a combination of full-time employees and part-time employees, and using a formula to count up the part-time employees to see how many full-time equivalents you have. So if you have, an example may be, if you have 30 full-time employees and 40 part-time employees, you may not have 50 FTEs. It's just a matter of the formula that you go through to figure out how many FTEs you have.
With respect to a question I think comes up with this, Jamie, is where you've got the 50 full-time equivalents, because all our clients are UK based with the US operation. Mm-hmm. My understanding is, and maybe you can clarify this, that 50 full-time employees is actually US based employees.
Yes, it's US W-2 employees. W-2 essentially means that they are attached to the employer and they're not contractors of the employer.
Yeah, and just for everybody's clarification, I'm sure everybody's aware, the W-2 employee is the equivalent of a P60 employee in the UK. Yep. But I think that is a question that comes up because we have clients who would most probably, when you take UK, worldwide employees into consideration, would be at 50, but right, still would be small under the US yes, healthcare reform rules.
Correct. Yep. One of the mandates, large group employees, they must provide what's called minimum essential and affordable coverage. Minimum essential means it must have a 60% actuarial value and be affordable. From an affordable basis, what it means is that your employees or your lowest paid employee cannot be paying more than 9.5% of their household income for that coverage. Their portion of the expense cannot be more than 9.5% of their household income. Now, generally, it's tough to find out what the household income is of a family. So the safe harbor of that is the employee's W-2, what is stated on their W-2 income. If you're paying more than that, then it's considered to be unaffordable.
So when you say that, so when you talk about the unaffordability, so maybe you can just give an example. So if that percentage of my W-2 comes out at 2,000, does that then mean if my premium is 3,000, the employer has to pick up 1,000, I only have to pay 2,000?
Yes.
Okay.
Yeah. In simple terms, yes.
Yeah.
Some of the consequences of the mandate, there are a couple of consequences. First of all, if a large employer decides that they are not going to offer coverage, period, and then one of the employees goes to the public exchange and gets coverage through the public exchange and qualifies for a subsidy, then the employer will be fined $2,000 per employee minus the first 30 employees. So just a quick example of that, in a company with 100 employees and they do not offer coverage, they would have a fine of 70 times the 2,000, which it's about $140,000. The second consequence is if you do offer coverage, but it's not considered affordable, then those employees that go to the exchange and qualify for a subsidy, you will be fined for those employees at $3,000 per those particular employees. Okay, and again, an example: you have 100 employees, 10 employees go to the exchange, you would be fined 3,000 times 10, so $30,000 for that particular situation.
Just with the large employers, because when we get onto the small employers, it's a lot more, from a penalty perspective, it's a lot more liberal.
Yes.
From a large employer, we're talking about you've got to have your 50 full-time equivalents based on your sort of W-2s. Is what happens if, because obviously as businesses grow, they go from 45 to maybe 55, they might go up and down a little bit. Is how does that threshold work if you go above?
It's an average taken on a per year basis, and it's usually a 6-month look back. There's a reporting process now where you file forms. It's 1095 A and B and C and 1094 A, B and C, which are filed. Some of those go to the employees, some of it goes to the IRS, some of it goes to the insurance companies, and it just tells you who's covered, what they're paying for their coverage, and how many FTEs you have, etc.
Is there anything though, like it's a sort of a bit of a, you have to be over 50, if you're at 51, so say you're at 49 and 51 in those 2 6-month periods, does that 51, if it goes back down to 49, do you get like a grace period where you get like 1 year that you have to be above 50 for an average of 2 years? Otherwise I could just see practically you could go above and below.
Right now it literally is that. You take a measurement each year. If you're over 1 year, then you've got to comply. If you're not, the next year, then you don't.
Okay.
So if you're in that sort of 45 to 55, where you could sort of, my advice to them is just comply.
Yeah.
Make sure your coverage is minimum essential, and also make sure that the coverage is affordable, considered affordable.
And with this compliance piece, is this normally, so for example, if you've got a client yourself that goes from the 45 to 55 and teeters across and goes up to 51, with all this paperwork that has to be done, because a lot of it's the compliance thing that I think would concern a lot of the business owners, is that something that you as your firm or firms in general handle for people, or is that something that the employer has to take control of and do?
From a technical point of view, it is the employer's responsibility, but they will farm it out, and we can help them in that process. We don't personally do those filings, but accounting firms, payroll firms, and there are also third-party administrators that will assist with those.
To make sure all the compliance is done.
Yes, absolutely.
Okay.
For large employers, important dates was the big date was January 1st of 2015 when you needed to be in compliance with the minimum essential and affordable coverage. Some of the strategies to control costs under the mandate, alternative funding, which we will get into a little bit later on in the presentation. Also offering multiple options of health plans, almost kind of like creating your own private exchange. And this is workable for large employers where you offer multiple options and you set your costs, and then the employees can buy up or down comparable based on what their personal needs are.
When we talked the other day, and we were talking about now maybe because when rules come in, businesses realise the costs will go up and they try and work a thing. When you're talking about this alternative exchange, is this what we were talking about the other day of sort of being the equivalent of a bit of a co-op?
Yes.
So what you're saying and you're seeing in the market with definitely the larger employers is because healthcare is becoming such a huge cost on people's P&Ls now, and because it's all based on claims and statistics of what the premiums would be, like any insurance, you're saying what you're seeing in the marketplace is some of the larger employers are almost going to try and set up a co-op and almost doing also like a little bit of self-insurance to even out their premiums so they all try and get a better benefit.
Yeah. Okay, moving on to small employers. Definition of a small employer is, surprise, surprise, anything under 50 FTEs, full-time equivalents. Under the law, they are not subject to large group mandates. They are subject to what's called community rating, which first began in 2014. That's blocked off. Early renewal options were offered to avoid going into the community rating, and that process has been a little bit like an amoeba. It's been changing sort of almost on a monthly basis on how often we can do this early renewal and keep with medically underwritten rates rather than community rating. Now, anticipating a question here, what is the difference between medically underwritten rates and community rating? Medically underwritten rates is when employees would complete a medical questionnaire just detailing prescription drugs they're taking, what medical conditions they have, and then the underwriter will rate them according to the information they have on those employees. Community rating has nothing to do with medical situations at all. It's all based on the zip code that you live on, the age of the employees, and whether they smoke. Gender is not taken into consideration either.
Yeah. Just another practical thing here is when we're talking once again about these full-time employee equivalents, it is based off the number of hours that are worked, isn't it? Mm-hmm. So for employers who are getting close to there and they maybe have seasonal workers or hourly workers, they just need to make sure they keep their timesheets and they're able to track and then do the calculations.
So you bring up a good point about seasonal workers. Seasonal workers, you do not have to count seasonal workers if they work less than 120 days in the calendar year.
So where that might be of interest is if you were getting close, I'm assuming if you took on an intern for a period of time.
Exactly.
And that intern just worked for you for a couple of months, that intern would not come into your calculation.
Right. Another good example is a landscaping company that brings on staff for the summer months, but doesn't keep them on over the, especially in Cleveland where our winters are rather long.
Yeah.
They don't keep them for that long. Under the Healthcare Reform Act, they developed an exchange called the shop, which allows small businesses to go to this shop. It's an online access to insurance companies and rates that are community rated. It has not generated a lot of interest right now because the rates, the options that are available through the shop are very, very limited, and secondly, the rates are rather high. You can still purchase group insurance directly through insurance carriers. They are subject to community rating, but the rates appear to be a little bit less than what they are through the shop.
Given the fact that I think almost everybody who's mostly on the call today from a US perspective would fall under the small employers we're talking about now. So this more, and given the fact that we talked about is, as a small employer, you're not required to provide insurance for your employees.
Right.
Not that that's good, bad, or indifferent from a retention and recruitment perspective, but what I think everybody needs to be aware of is that even if you don't offer the insurance, your employees still has to take out insurance, or else they can be penalised themselves.
Yes. Yeah. Yeah. The employees are, and we'll get into this a little bit later on. They are subject to fines if they do not have qualified insurance themselves. So it is still considered to be a very good benefit for small employers to be offering, and probably the majority still offer it. Under the healthcare reform, employees can keep their dependent children on the health plan up until age 26 under the federal mandate. If you have a business in Ohio, Ohio has a separate law which allows them to keep them on until age 28. There is some W-2 reporting that is required. Any employer that generates more than 250 W-2s in a calendar year is required to report the cost of the benefits provided on each employee's W-2. Other mandates, there are some new fees that are associated with health insurance premiums. The PCORI fee, which is the Patient-Centered Outcomes Research Institute, I'm amazed I remembered that, fee, which basically funds research into cancer and other diseases. Then there's a reinsurance fee. This fee is there, and this fee is there for a limited amount of time, and it's designed to reimburse the insurance companies for the losses that they will take on by having to insure everybody without regard to medical conditions. And then the third one is the market share fee, and this is essentially just insurance companies with larger market share in a particular area will pay a larger fee than smaller insurance companies. It's essentially leveling the playing field. Okay. All preventive services are mandated to be covered at 100%, subject to no deductibles or co-pays, etc.
So I think if that was how our plan works, is basically if I sign up every year to go to a medical to see my doctor, basically in effect the insurance premium, the insurance plan covers that 100%, and I don't pay anything out of pocket, because the whole idea is if I go on a regular basis, they catch something earlier, so it costs the insurance company less.
It cannot be a diagnostic visit. It's got to be they're just doing a routine sort of checkup, just make sure that everything's working as it should.
Are there other things that, because I remember before Obamacare came in, health insurance companies were saying if you joined a gym or you did certain things, or the company got everybody to walk so many steps or something in a period of time, because you were trying to keep your employees fitter, that actually had an impact on your premiums for the year. Is that still good, or does that, under Obamacare now, is that sort of gone away, or are those things you can do within a plan to help reduce your premium?
Well, wellness is a very interesting subject. With the community ratings, the employees or employers really have very little control on the cost. So the incentive of offering wellness, in my opinion, has kind of gone away. But if they look at some of the alternative funding options that we'll talk about a little bit later, then the wellness options become a very relevant part of their plan. Small employers have the option to take part or take advantage of what's called the Small Business Healthcare Tax Credit. Now this is a tax credit for businesses that have less than 25 employees and have an average salary, not including the executives, of less than $50,000. And under that credit, if you buy health insurance through the shop that I was referring to earlier, you can get this credit, and the credit can be up to 35% of the total premium. I've done a couple of analysis on this with some of my clients, and because of the difference in cost, it really hasn't made a lot of difference, or made it worthwhile to do that.
So basically what you're saying there is if, for example, for us, we take out insurance with your company.
Right.
And that gives us the best rate.
Mm-hmm.
If we'd have gone and said, no, in actual fact, Jamie, we want to go to the shop because we think we can qualify for the credit, you're saying that by the time you get the premiums from the shop and you take the credit from it, we're most probably back in no different situation than if we just went with your plan.
Yeah, I'm not saying it won't work for, there may be occasions where it will work, but in general, I haven't found that it has worked very well. Mm-hmm. One of the requirements, moving on, one of the requirements is the summary of benefits of coverage. Every employee, including employees that are not taking the coverage, needs to receive what's called a summary of benefits and coverage each year at each annual enrollment.
And I think, as you've told us, is not only with the summary of benefits, is that the same as, in a sense, so if we've got an employee who is on their spouse's insurance at another firm,
right,
and they decide not to take ours, that we are supposed to get them to sign off to say they've been given the option to come in, right, but they've waived the option.
Yes, yeah, you should have them sign a waiver. It's different to the SBC, but they should sign a waiver.
Yeah.
Consequences of non-compliance. Providing health insurance will benefit small employers from a retention standpoint, but there are no financial consequences for choosing not to offer health insurance to employees. Generally, most employers are still offering benefits in some manner or form.
I think it might be interesting just to mention here, is, as you and I have discussed, in the UK, obviously, we all understand there's the NHS system.
Right.
But I think now quite a few employers are offering private medical as well. In the UK, if you offer private medical, that is a benefit to the employees, right, and they end up paying tax on it. So it costs them, in a sense, the tax piece on their benefit statement. However, in the US, when you offer healthcare incentives to the employee, it's never taxable to the employee.
Correct.
And so, in effect, it's sort of the reverse. So it's actually a big benefit to employees in the US, because it is really something, it's free cash in effect.
Yes, it is. Yeah. Absolutely. The value of offering a health insurance plan to an employee is probably, depending on whether they're single or taking family coverage, adds anything from $7,000 to about $15,000 to their salary, and that is all tax free.
Yeah. When with the clients you're dealing with and a lot of the owner managed businesses, to give everybody on the thing a bit of a sense of what do you normally see? Do you normally see employers paying 100% of the premium? Do you see them paying 25% or something in between? What's the...
We're going to get into that a little bit later on. We've got some slides from the Kaiser Family Foundation that sort of gets into the averages of that.
Okay.
But generally, employees are contributing towards their health plan. Very quickly on individuals, and this is where small employers can help their employees, because all individuals must purchase health insurance, and this was a mandate as of 2014. And they can, if they go through the public exchange, they can get a subsidy. The subsidy is available to families that have income between 133% and 400% of the federal poverty level. You can also purchase through the private exchanges. That's not attached to the government, but the subsidies are not available through the private exchanges.
Can you maybe expand on that, because some of the terminology when we talk about certain things is different, is a little bit challenging. So in layman's terms, what is the public exchange?
Public exchange is a government-run, essentially, website that private insurance companies post different health plans available to the general public. The pricing is controlled by the government. The government, each insurance company has to submit their rates to the government and get them approved by the government. And then they're posted on the exchange, and then the employees can go and choose, for instance, United Healthcare and a plan from United Healthcare, and they can get a rate. And based on a certain metallic level, they can get a subsidy for that particular premium based on what their income is. And essentially what it does is it makes sure that you pay no more than 9.5% of your total income to pay for your insurance.
Okay. And then the private exchange, that's just going for us going to you, and you look in just privately what's the best rate for us.
Yes. Yep. Okay, consequences of not buying an individual health insurance for someone who doesn't get group insurance is there's a ever rising fine. It started off in 2014 as the greater of $95 per individual and $47.50 per child, up to $285 or 1% of the family income, whichever is greater. And then it raised and it's progressed up to, in 2016, greater of $695 or total family of $2,085 or 2.5% of their income, whichever is the greater.
It's interesting, just as that we have one or two of our clients that don't take out insurance, so when we do their personal returns, you have to calculate the penalty.
Right.
I think one client this year I saw there was a penalty of about $4,000 or $5,000.
Right.
So it can become a sizable number for not being covered.
Yeah. But there are things that you need to be very careful of because people's income fluctuate, and if someone is on the exchange and taking a subsidy, if their income goes up, the government's going to come back and want their money back. It's not an annual thing, and then you recalculate it after an. They will, as soon as their income goes above a certain threshold, then they'll want their money back.
And we've had those situations as well where individuals have gone on the public exchange. At the time when they submitted it, they said their income was a certain level.
Right.
So they got a credit, so they paid a reduced amount for their health insurance.
Right.
When we came to do the tax return, things had changed and they'd gone above the poverty line, and now all of a sudden they were having to repay the credit they'd got back, and all of a sudden now it's cash going the other way.
Right.
So you can have shocks like that. So I think it's a good point. People just need to be aware that if they're doing it on a private exchange, or if you've got a small employer that says, look, we can't do the healthcare for you, and the employee gets it, they just need to be aware there's sometimes be a catch-up.
Yeah. Okay. For individuals, the important date was January 1st of 2014, and we're well past that right now. Okay, alternatives to the healthcare reform. The first one is the MEWA, which is the multiple employer welfare arrangement. This is a health plan that is offered by multiple employers to their employees. It comes under the it is a self-funded contract, and it's allowable in Ohio under State House Bill 64. They have to comply with state regulations, and they also have to have similar capital requirements as an insurance company, generally offered to employers with less than 50 employees. This is a very real option to the community rating because it is medically underwritten, and so if you have a business and you feel that you have relatively healthy employees, this is a very good option to take a look at. There's also a level funded health plan. This is a self-funded contract that is governed under ERISA. ERISA is the Employer Retirement Income Security Act that was passed back in 1973, and all benefit plans have to comply with ERISA. This allows smaller employers that cannot tolerate fluctuations in cash to provide a health plan under a self-funded contract with consistent monthly payments. The employer never pays more than the funding agreement, but may receive a refund depending on how their claims have gone through the year. Then the group captive arrangement. This is, for any of you that insure your businesses commercially, you may be familiar with a captive arrangement. This allows a group of employers, generally 40 FTEs and above, to share risk over and above their own specific and aggregate stop-loss deductibles. The captive would pay the dividends to member companies based on the overall performance of the plan. This these options that I'm talking to you about, this is where the wellness of your employees become a real incentive to you, and you want to be thinking about how you can incent the employees to be in compliance with wellness programs. Traditional self-funded, this essentially you have a stop loss. You have stop loss coverage, which is specific, which is on each individual, and then aggregate, which is an actuarially calculated number that the whole company takes.
So this might be in a situation, because I think in reality, to be self-funded, meaning that in effect is the employers pay all the claims and stuff like that instead of paying the premiums. So they're taking,
Right.
They're basically on analysis say the amount I actually would have to pay out in claims or medical bills is less than what I'd have to pay the insurance company, so it makes sense.
Right.
But
then you insure at a higher level. So you may take say $30,000 of risk on each employee, and then the insurance company pays over and above that, and then you may and then the actuarially calculated number may be, I'll just pull a number out of the sky right now, but maybe 150,000, and you'll be insured at about 125% of that number.
Mm-hmm.
Okay, and then once your aggregate claims go above that 125%, then the insurance company takes over. So you are capped on your risk, but you take the risk for the smaller claims.
from a practical perspective, with clients that you maybe see self-funded, I'm assuming they're going to be at least 50 or more employees. Your smaller employers are always going to go to a health insurance premium. I'm just my guess is
not necessarily. A few years ago, I would agree with you, but in today's world, I've seen I have clients that have less than 25 employees that are taking a self-funded contract. They sometimes go with the level funded program because it gives them a consistency of premium that they're paying out, but it gives them the option to have get money back and also probably have a lower premium than the community rates.
So this might be in a perfect situation where maybe you have a small company that maybe all the individuals are fairly young and healthy and in an office environment,
right,
where hopefully the claims wouldn't be huge.
Yes.
But then at the same time you can take out like a stock policy that mitigates if there was something catastrophic.
Exactly. So what are employers doing? With the onset of PPACA, benefits offered by employers are no longer first dollar coverage. Employees are usually subject to a deductible ranging from $500 up to $6,600 per individual. That 6,600 number, while it's an odd number, that's a mandated maximum under the PPACA.
And once again, because I think most everybody does know, but just in case, from a deductible perspective, that just means that if our deductible on our plan is $6,000, it means that I've already paid my insurance premiums, but when I go to the doctor or go to the hospital, I don't get any benefit from my insurance policy until I've spent $6,000 out of my own pocket.
Correct.
And then the insurance will kick in and then will pay the premium, pay my medical expenses.
That 6,000 is an annual amount, so it's not a per event amount. It's an annual amount. So you could, if you have multiple situations, if you had a big surgery in January and you met that 6,000 then everything else is going to be covered at 100% for the balance of a year. Okay. Premiums. Employers will also ask employees to share in the cost of premiums. This share will vary according to industry. So I've got a few slides here, and generally these slides are coming from the Kaiser Family Foundation. It's a big foundation based in the USA. They do a lot of different surveys and studies, and one of them is on the state of healthcare in the United States. And I've pulled a few slides for you based on the contributions that employees are paying. And if you see this slide, over the years since 1999, the percentage of premium that the employees are paying has stayed fairly consistent. The family is, right around, it's gone from 27 to about 29%, so it's to say very, very consistent. The Single coverage has ticked up a little bit. It's gone from about 14% back in 1999. It's around 18, 19% right now. So if we want to go.
So what this is showing is this is sort of saying if I came to you and said, Jamie, look, I'm going to take out insurance for our employees. What do you think the ratio should be of me as the employer putting in compared to the employer? You say, well, Rob, you put in 25%, and the employer will fund the other 75%.
Yeah.
And that would, based on this would consistently say this is what the trend has been for several years.
Yeah. Now, what you know, that was just based on a percentage basis. Where it has been very different is if you look at it from a dollar perspective, and this is purely down to the continuous rising of healthcare costs. Someone who's taking single coverage from a dollar perspective back in 1999 was paying about $27 a month for their coverage, and that was based on about 14%. And today they're paying about $89 per month on their coverage, which is equivalent of about 20% of the coverage. And then if it's even more dramatic on the family coverage. They went from about $129 at around 27%, and then $413 at around 30% right now. So the dollars is a dramatic difference. So just the percentage stayed about the same. This gives you an illustration of what the total cost of insurance is and what the employees are paying and what the employer is paying. The dark number, probably looking at all plans at the bottom of the screen, a single employee is paying about $1,071 per year. The employer's proportion is $5,179, so a total roughly of $6,251. And then, as you can see, family coverage is a lot more dramatic. $4,900 for a family for their cost. The employer's cost is about $12,500, total of $17,500.
So just the difference with these, the HMO, just trying to give a correlation back to the UK. The HMO is when you can only go to somebody specific, right?
Right.
So that in the UK, that would be for everything to get covered under the insurance plan, you would have to go to your local GP, and he would have to deal everything. And if he sent you to anywhere else, you'd be paying for it out of pocket.
Not exactly correct. No.
Okay.
With the HMO, you have to be in the network, and you have to coordinate your care through the GP. Mm-hmm. But the GP can refer you to a specialist within the network, and then you would continue to get the benefits with it that are provided in the network. If they were to refer you outside of the network, then you would have no benefit.
So just to keep that simple, so when we talk about the network, it would be like, so say for example in the UK we said Shropshire, all the doctors in Shropshire were in the same network.
Correct.
If that doctor referred me to anywhere in Shropshire, then I'd be fine. But if I need to go and see somebody in Yorkshire, I'm now paying out of pocket.
Yes.
Whereas when you get down to these other scenarios here, is potentially that gives you the ability to go into Yorkshire and still be covered by your insurance.
Correct. Yes. This essentially goes through average annual worker contributions for covered workers with single coverage by
the firm size.
By firm size. So smaller firms, interesting. This is an interesting statistic when you see the next slide. Smaller firms are generally paying more for their single employees than larger firms. And smaller firms are identified as between 3 and 199 employees. And then you'll see that the slide flips around for family coverage. The larger employees are providing more or taking on more of the cost for larger employees than smaller employees. So deductible cost sharing, again, looking at this by different types of plan. The HMO, which has the very, very restricted network, they have the least amount of deductibles because in return for having a very restricted network, you have a higher benefit. The PPO networks generally have more companies with deductibles, or more plans with deductibles. Same with point of service. And generally, if you look at all plans, most plans in today's world, or over 80% of the plans, have some sort of deductible. And these are the average sizes of the deductibles, and again, they go from anything from $1,400 to about, average about $2,600. I will say that there are a number of companies that have plans that are significantly more than $2,600 in deductible. Just to really quickly describe what an HDHP, that's a high deductible health plan savings option. These are what's called qualified plans. You have to have a certain high deductible, but it allows you to have a bank account attached to that account, insurance plan, where you can put money into that account on a tax-free basis to be used for medical expenses that covers the deductible.
So you were talking here about a health savings account, a HSA?
Health savings account. Yeah.
Now, but we've had these discussions before, and I think this is a good thing. Am I right in thinking that you're seeing now that, in effect, of where you want to maybe try and make the employee and the employer responsible for their health care, that, and taking into consideration the pricing then, that it almost seems like very often the best option comes to use a high deductible plan, so where you've maybe got to pay the first $5,000
right
to qualify for this, have your employee or employer fund the HSA, so fund that difference of the non-deductible, and that ends up being most probably overall the best outcome on a lot of situations. I know that's what we use.
Right.
So and I think that works well, because you reduce your costs. You've then still got the insurance, and my perspective, if there's something critical, that all of a sudden I was in a road accident and it's cost $100,000, I'm only out of pocket $6,000,
right,
which basically my HSA contribution has paid for, which I had as a tax deduction. So in reality, it really cost me just the after-tax money for my health coverage.
Correct.
And then the other nice thing with that HSA is when you put it in there, it stays in there and grows and is an investment account.
Yep.
And it grows and grows, and my understanding is that if you never use it for medical expenses, when you retire, it almost becomes a pension to you, and then you can draw out as a pension at that stage. So it's almost like a pension plan plus health plan at the same time.
Yeah, for some of the higher net worth employees, it's actually a great alternative. Because most of them will max out their 401k plan. You've got certain limits that you can put into that plan. And this is another alternative, because you can put up to as a family, you can put up to $6,600. As a single, you can put up to $3,300.
Yeah, yeah. So. What I think we've also talked about before is what's interesting. We've been talking about single coverage and family coverage and stuff like that. And I think going back 5-10 years ago, very often a lot of firms would have the health coverage out there and open it up to the whole family.
Right.
And very often you might have a spouse who worked for somebody else that maybe didn't have as good a health coverage and would actually come and use your policy. My understanding now is if you're advising a business, you would say if your spouse can be covered by their policy for their employer, to not cover them under yours because it has a big impact potentially on your insurance premiums.
Yes, especially if you're going to be in the risk part of this.
Yeah.
You want to control that risk as much as you can, and if you can control some of that cost by requiring spouses, if they have coverage available elsewhere, to be on that other coverage. A, you don't incur that cost, and B, you don't incur the risk either. And if you look at claims statistics, you'll very frequently find that the dependent spouse is the one that's driving the claims costs.
Okay. As I see, there's just one slide left with respect to deductibles.
Yeah. So yeah, this is breaking it down by large and smaller employees, which showing how many the percentage of businesses that have deductibles over $1,000. Small businesses, 63% over $1,000. So generally, deductibles for small businesses are going to be higher than large businesses. And then larger businesses, it was about 39% over $1,000. What you want to take into account for larger businesses is there's a lot more prevalence of unions in larger businesses, and they've negotiated very high benefits and so on.
So I think that rounds it off well. I think you covered a lot of nice stuff there. We've got sort of 15 minutes. We've got a few questions that come in.
Okay.
One I'll actually just start with is, obviously, I think as you said, you will see healthcare as a great recruiting tool, and when you've got people coming on board, it's important that you've got healthcare. Are you seeing, it was interesting, I had this conversation yesterday, are you seeing healthcare as being a great retention tool as well for employees? Because I think we're all definitely here in the States, I think anybody who's operating in the States, to find good people and retain them is becoming a big challenge. Have you seen, in effect, that talking to other clients, that maybe the better the benefits, the better the retention tool, or are you not seeing a real correlation?
Yes, I do see it as a retention tool, especially for the less transient type businesses.
But you're seeing it a little bit, but it's not out there definitely seeing that in effect is if you give them the Cadillac program, the best of the best, that they're never going to leave, or it's a huge retention tool. But it's certainly a good recruiting tool.
Yeah, certainly a good recruiting tool. It is a retention tool combined with other benefits that are offered as well.
Okay. We've got one question here, and you maybe obviously as you become a larger employer, we're talking about the cost of compliance. How is that normally priced? Is it is it something you normally pay for separately? Is it something that gets factored into when you take out the insurance program, or do you know? Is it $1,000? Is it $5,000? Do you have any comments on that?
Depending on the different services that you get, because there's a number of things that you have to be in compliance with, especially under ERISA. You need to make sure that all your plans have summary plan descriptions, which is different to a summary of benefits and coverage. Though, there are services that will provide that, and depending on the size of the business, I would say that you want to budget for about $5,000 to cover A, being in compliance with ERISA, and B, filing the 1095, 1094 filings, and the PCORI reinsurance fee and the market share fee.
Okay. That'd be interesting, because another good question that comes up is, in fact, when you're looking to come to the US, obviously you're trying to budget your costs and stuff like that when you're trying to put together things. Have you got a rough percentage of saying that, in effect, is as if I got paid $100,000 to add on the cost, would you have a percentage of what you should maybe add into your budget for employee healthcare costs? It's like 5%, 10%.
Yeah, I would. Well, what I can say is you can add probably about $7,000 per individual.
Mm-hmm.
Okay, for total costs, and then whatever you want to ask the employee to pay, you could take off of that number.
So if that comes into something, I see very often with our clients that if it's an individual, so like myself, it's maybe my premium maybe about $400 a month, so that's about $5,000 for the year.
Right.
But if I was married and had kids, then it might be about $1,000 a month, so about $12,000 a year. Would that be sort of fair?
Yeah. So yeah, if you're budgeting between $7,000 and $9,000, you're going to be in them. Especially if you are planning on providing coverage for the total family, and you are going to contribute significantly towards that, then yeah, that's a number I would want to use.
I know you're based here in Ohio, and obviously the rates are based, as you talked about, on the community ratings and stuff like that. Are there any particular states, from your experience of talking to colleagues and stuff like that, where you say, crikey, if you go to, I don't know, California, health insurance cost is at least 50% more than it's in Ohio. Do you see any big variances between the cost of insurance between different states, as we have clients all over in various states in the US?
There is a fairly significant difference. Up in the Northeast is significantly more than here, and in fact, the Kaiser Foundation, some of the slides, I didn't put them on this presentation, but some of the slides show cost by region, and if you want, I can pull those and send them over to you so that you can distribute them. California is pretty expensive. In fact, not to discourage people to move into the beautiful Cleveland area, but Cleveland, because of the significant hospitals we have in this area, is fairly expensive if you look at it from a region-to-region basis.
Yeah. On the positive side, though, the hospitals are very good.
On the positive side, the hospitals are the best there is.
Yes. Yeah. So you get what you pay for. Yeah. Talking about, just to clarify once again, with the employees, where we talk about full-time, and because we're talking about all UK businesses coming to the US, when we talk about that 50 full-time employees, it is only the full-time employees within the US operation that you have to consider.
Yes. And under federal law, 30 hours is considered to be full-time per week. 30 hours per week is considered to be full-time.
And is there anything, maybe you might explain a little bit about the discrimination rules, how those sort of work, because I think very often when you're looking to employ people, you're looking to sort of say, yeah, I want this person, Jamie, I want you to come work for me. You're a fantastic guy, and I want to make sure you get the best benefits. And then they look at me and go, well, Rob, you're an okay employee, and we'll give you a little bit, we don't give you too much. Can you explain how you're allowed to do that, or?
No. It's a plain and simple answer. You cannot discriminate on what you're offering and what you're asking the employees to pay. Now, you can at the present time discriminate on what you're asking the employees to pay by class of employees, but that is likely to be going away because there's a real push. It was delayed for a while in the healthcare reform law, but there's a real push to sort of even out what employees are paying, because there was a trend where executives were getting all their benefits paid for, and the should we call them worker bees, were having to make a contribution, and that was considered under healthcare reform, that was considered to be unfair, and so you're still allowed to do it right now, but that will probably get implemented over the next year or two.
Okay. The other thing as well is, which we've been talking about group health insurance, so in business. So quite often as well, we might be in a situation where we have a situation for a UK company and they send one person over here to start the company up. Mm-hmm. And obviously they need health insurance. My understanding is that if you've just got one employee, is it very difficult to get group health insurance?
It is tough, yes. There's one situation in the Ohio area where we can get a group of one, and that's if you go through the Greater Cleveland Partnership, their COSI program, you can buy a group of one for that.
And once again, is so that everybody understands, and it might be the same in other states, the COSI program is more the fact is it's an organization where smaller businesses can sort of, once again, join as a co-op.
Right. And
then in effect, for certain things that might be difficult to get, and I know it's not just health insurance, but you can then always have group buying power.
Right. Such as the Chamber of Commerce.
Yeah. And I think the other thing as well that's interesting is, if you, with respect to that, if you don't do that, your only other option is the individual either doesn't take any insurance, or they buy it themselves as an individual.
Yeah. And as an individual, it's not tax deductible. Okay. So group benefits are tax deductible. Individual insurance is not.
So if the employer wanted to realize this and wanted to help, because the employer can't reimburse them now under the rules for paying health insurance. So if they wanted to sort of do that, they could always, in a sense, say instead of your salary being 20 grand, it's 30 grand.
Right.
And that goes through as 30 grand of compensation, which is fine in the company. And then in effect, if that person wants to use that excess to buy their health insurance, it's a workaround with respect to that. This is question. This is maybe more a general question. Is if I don't have, and you may or may not know, because it's a bit of an esoteric, but if you don't have any insurance, how do you receive health care in the US?
Well, under federal law, if you go into an emergency room, they have to, by law, provide services to you. Now, it's going to be fairly basic services where they're just going to get you stable. So if you've got minor ailments, you can go to a clinic and just pay cash. And now you'll pay significantly more under that arrangement than you would through a health insurance plan.
So, just as an overseas company, can I have an international health policy covering US employees? I'm assuming everything's possible, but I imagine if you take a travel insurance policy, it becomes more complicated.
If the employees are based in the US,
yeah,
the plan that they have has to be in compliance with the healthcare reform law. So if it's an international policy, they need to make sure that it complies with the minimum essential coverage and the affordable part of it.
Okay, so what about if, take it a little bit, so say obviously a lot of the companies we work with, their high-level management's in the UK,
right,
and they have to travel over here. Okay. In those situations, I imagine the most practical and affordable is you have a travel insurance policy.
Yeah, right.
And in effect, hope you don't have to use it and have to get into all the paperwork.
Right. Yeah, because essentially they are not US employees, so yeah, that's a perfect solution.
I was going to say, I see it's about 3 minutes to the hour. There's a couple more questions here which we will follow up directly with the individuals so we don't leave any questions unanswered. But I want to make sure that nobody overruns because I'm sure everybody's got important meetings to go to. So, Jamie, I'd like to thank you very much for coming in and sharing a lot of very valuable information, and I'm hoping that everybody on the webinar found a lot of benefit from it. So thank you very much. And
thank you very much.
You'll see on the slides there is Jamie's contact information, and if you need anything directly to get a hold of him, then you can email him directly, and we'll go from there. So thank you everybody for attending. We intend to put another similar presentation on in about 3 months' time on another topic which we believe is very critical or crucial with respect to businesses coming from the UK to the US. So thank you all very much, and I hope you have a good rest of your day. Thank you.